If you think Bitcoin falling to $63,000 is the real story, you are watching the wrong variable. The price is noise. The structure underneath it is the signal. And most investors don't know how to see the difference. When Bitcoin collapses sharply, the market immediately splits into two emotional camps. The panic sellers, it's over, the cycle is done. The blind believers, just a dip, always buy the dip. Both are reacting emotionally. Neither is analyzing structurally. Here's the uncomfortable truth. A 10 to 20% drop in Bitcoin is not abnormal. It is structurally embedded volatility. Since inception, Bitcoin has experienced dozens of 20 to 40% corrections inside bull cycles. In traditional equity markets, that would qualify as a crash. In crypto, it's a stress test. The retail investor interprets volatility as information. The professional investor interprets volatility as liquidity transfer. That difference alone separates survival from liquidation. When Bitcoin drops to $63,000, the right question is not, is this the end? The right question is, what kind of reset is happening? Because markets don't collapse randomly. They reset imbalances. The drop itself is not the event. The imbalance before it is. And if you don't understand what was imbalanced, you cannot understand what comes next. Let me show you how experienced investors analyze moments like this, not through emotion, not through Twitter narratives, but through structural layering. I call this the three-layer reset model. Every major Bitcoin drawdown can be classified into one or more of three reset types: leverage reset, liquidity reset, narrative reset. Let's break them down. This is the most common. When Bitcoin rallies aggressively, traders increase leverage, perpetual funding rates rise, open interest expands, liquidation levels stack tightly below price, the market becomes fragile. Then a catalyst appears, a macro headline, a large sell order, a funding imbalance, a stop cascade. The result? Liquidations trigger liquidations. Forced sellers hit the market. Price falls not because belief changes, but because margin disappears. This is mechanical, not philosophical. In a leverage reset, spot holders remain. Long-term conviction is unchanged. The damage is primarily in derivatives. If $63,000 is primarily a leverage flush, then this is structural cleansing, not structural breakdown. Professional investors watch open interest contraction, funding normalization, liquidation heat maps, basis compression. If those unwind while spot demand remains stable, this is not a collapse, it is a purge. Liquidity reset. When money leaves the casino. This is more serious. Crypto does not move independently of global liquidity. Despite the narrative of digital gold, Bitcoin is still deeply correlated to liquidity cycles. If dollar liquidity tightens, treasury yields rise aggressively, risk assets de-risk globally, stablecoin issuance slows, then capital is not rotating. It is exiting. Liquidity resets are not about leverage. They are about available capital. The market does not crash because people panic. It crashes because there are fewer buyers. If Bitcoin at $63,000 is occurring alongside contraction in stablecoin supply, ETF net outflows, declining on-chain activity, and risk-off sentiment across equities, then this is not just a technical flush. This is capital retreat. Liquidity resets last longer. They grind, they frustrate, they erode confidence slowly, and most retail investors cannot emotionally survive them. Narrative reset. When the story breaks. This is the deepest reset. Markets are storytelling machines. Bitcoin's price reflects not just money, but belief, ETF adoption narrative, institutional participation, halving supply shock, sovereign adoption, digital gold thesis. If price falls but the narrative remains intact, capital eventually returns. But if price falls because the narrative weakens, the recovery becomes nonlinear. Examples of narrative fracture: regulatory crackdowns, exchange insolvencies, structural hacks, political bans, systemic trust damage. Narrative resets are not measured in percentages, they are measured in belief decay, and belief decay is slow to reverse. Applying the model to $63,000. Now we ask the professional question, which reset are we observing? Let's analyze logically. If this drop to $63,000 occurred after extended leverage buildup, with elevated funding, with heavy long positioning, followed by liquidation cascades, then this likely fits the leverage reset category. But if stablecoin supply is contracting, macro liquidity is tightening, ETF flows are net negative, risk assets broadly weakening, then the probability shifts toward liquidity reset. And if there is structural regulatory pressure, major infrastructure failure, breakdown in institutional participation, then we consider narrative reset. Notice something critical. These categories are not emotional, they are structural. Retail investors ask, should I sell? Professionals ask, what layer is resetting? Because your action depends entirely on which layer is failing. A DIC is price only. A reset is imbalance correction. Most investors cannot distinguish the two, so they oscillate between fear and overconfidence. Here's the veteran truth. Markets do not collapse from price weakness. They collapse from structural fragility. Price is the symptom. Fragility is the cause. If fragility is limited to leverage, the reset is sharp but temporary. If fragility is liquidity-based, the reset is prolonged. If fragility is narrative-based, the cycle changes. That's the hierarchy. And if you misclassify the reset, you misposition capital. Because they are trained to think directionally, up equals good, down equals bad, but markets are probabilistic systems. A 15% drop does not change long-term structure, but it does change positioning. Professional investors look for positioning imbalance, sentiment extremes, liquidity gaps, capital flow shifts. Retail investors look for red candles, headlines, influencer reactions, emotional validation. The market transfers money from the second group to the first, quietly, systematically. Before reacting to $63,000, zoom out, not just on the chart, on the structure. Ask yourself, what was overextended, what was crowded, what was fragile, what has now been flushed, and more importantly, what remains intact, because the assets that survive resets are the ones that compound. Take a breath. The market is not asking you to predict, it is asking you to classify. Now that we've classified the possible reset types, we move to what professionals actually care about: probability distribution. Not prediction, not certainty, not emotional conviction. Probability. From $63,000, there are only a few structurally logical pathways. Path A, the elastic rebound, leverage reset completed. If this was primarily a leverage flush, open interest contracts sharply, funding normalizes or flips negative, liquidation heat maps clear, spot accumulation quietly increases, then price often stabilizes and rebounds. Why? Because the forced sellers are gone. When leverage is wiped out, the market becomes less fragile, volatility compresses, price finds equilibrium, then capital re-enters. These rebounds are violent, they feel surprising, they punish late sellers. Retail interprets this as manipulation. It is not manipulation. It is structural stabilization. Path B, the grinding compression, liquidity reset. If liquidity is tightening, ETF flows stay weak, stablecoin growth stalls, macro remains risk-off, correlation with equity strengthens, then price may not crash dramatically. It may grind, slow bleed, choppy range, false breakouts, failed rallies. This is the most psychologically destructive scenario. Why? Because nothing decisive happens. No dramatic collapse, no explosive recovery, just erosion. Investors become exhausted, attention fades, capital rotates elsewhere, the market doesn't crash, it suffocates. and most retail investors quit during suffocation phases. Path C, structural breakdown, narrative reset. This is the least common, but most consequential. If belief fractures, institutional allocation pauses, regulatory pressure intensifies, trust events occur, long-term holders distribute, then the cycle truly resets. Not 15%, not 20%, but structurally. Lower highs, lower lows, sentiment collapse, capital desertion. This is not volatility. This is cycle transition. But here is the key. Narrative resets leave evidence. They do not hide. If we are not seeing structural institutional withdrawal or systemic failure, we must not prematurely label this as the end. Professionals require proof before changing regime classification. Retail requires fear. The phrase total reset sounds dramatic, but structurally, a full reset would include extended liquidity contraction, multi-month ETF outflows, weak on-chain demand metrics, prolonged minor stress, deterioration in macro risk appetite, declining developer activity, and narrative fatigue across media. That is not one red candle. That is systemic cooling. Markets don't implode overnight unless leverage is extreme. They decay through structure. So the correct question isn't, is this the reset? It's, are the structural conditions aligning for one? So far, a move to $63,000 alone does not qualify. It qualifies as volatility. Volatility is not regime change. Here's where retail and professionals completely diverge. Retail thinks in binary, all in, all out. Professionals think in exposure gradients. If probability of path A increases, incrementally scale exposure, avoid leverage, monitor structure. If probability of path B increases, reduce risk, preserve capital, avoid directional aggression. If probability of path C increases, transition defensive, prioritize liquidity, protect long-term capital. Notice something. No prediction required, only conditional adjustment. The goal is not to guess correctly. The goal is to survive uncertainty, because survival preserves optionality, and optionality is the most undervalued asset in investing. Because humans crave narrative closure, they want, it's over, it's going to zero, it's about to moon. Certainty is emotionally comforting. Probability is psychologically uncomfortable, but markets reward discomfort tolerance. When Bitcoin drops to $63,000, influencers amplify fear, headlines amplify drama, social media amplifies emotion, very few amplify structure, and the market transfers capital accordingly, not based on intelligence, based on emotional regulation. The real question you should be asking is not, will it bounce, or is this the end? Instead, you should be asking, what would invalidate my thesis? Professional investors predefine invalidation, while most retail investors never define it. For example, if ETF flows reverse sustainably, if macro liquidity shifts expansionary, if structural higher lows remain intact, then the thesis remains. But if structural support breaks across timeframes, institutional participation declines, or liquidity contracts persistently, then the thesis adjusts. Most retail investors never define invalidation, so they react emotionally in real time, and emotional reaction is the most expensive investment strategy. Step back from the noise. Look at the chart. Now zoom out 2 years. Now zoom out 5. Now ask yourself, is $63,000 catastrophic in that context? Or is it movement within a volatile asset class? Take a breath. The market is not demanding urgency. It is demanding clarity. Clarity requires distance. When you take a step back, what once seemed urgent becomes simply part of a larger pattern. Markets reward those who can gain perspective, not those who react impulsively. The insight most investors never internalize is that volatility is not the enemy. Fragility is. Bitcoin can drop 20% and remain structurally healthy. It can also rise 20% while becoming structurally fragile. Up does not mean safe. Down does not mean broken. The threat is leverage concentration. The threat is liquidity contraction. The threat is narrative fracture, not red candles. Once you understand this, you can never see market drops the same way again. Because you stop reacting to price, you start diagnosing structure. And that shift alone separates participants from professionals. Every major move is a filter. It filters over-leveraged traders, emotional participants, and narrative chasers. And it rewards capital preservation, structural thinking, and emotional discipline. Bitcoin at $63,000 is not a verdict. It is a test of your framework, a test of your patience, a test of whether you operate probabilistically or emotionally. Markets do not eliminate people randomly. They eliminate those who misclassify risk. The reset, if it comes, will not announce itself loudly. It will appear in structure first and only later in price. Until structure confirms regime change, $63,000 is data, not destiny. No panic, no celebration, just analysis and positioning.